This halving chart is, you can see the discipline here. It's been mathematically metered, and actually we did a Bitcoin brainstorm with miners. This monetary policy basically was written in 5 lines of code. I did not know that until we did that Bitcoin brainstorm. It is so elegant, so simple, so straightforward. So in contrast, take a look at this. All right, this is M2 growth, and it's a 4-year annualized percent change. And you can see it's all over the place. You can see in the 60s and 70s, it moved toward double digits, and we ended up with double-digit inflation. We're in a very interesting environment, and it's caused by monetary instability around the world. If by the end of the year we stabilize around 0% year-over-year growth, that's year-over-year, this line will drop toward 2 to 3%, which, as you can see, we've only seen once. It was in the 90s, and, after that, all hell broke loose around the world.
Bitcoin has now undergone its 4th ever halving, putting its supply growth at under 1%, notably falling under the growth rate of gold. This is in stark contrast to various fiat currencies around the world, including the US dollar, which has had extremely erratic increases and decreases in supply. In her latest In the Know market update, CEO and CIO of Ark Invest, Cathie Wood broke down why Bitcoin is inevitably going to move upwards as fiat currencies devalue due to their built-in instability. Cathie points out that fiat currencies are innately extremely volatile and thus unstable, as their growth in supply is up to the whims of central banks and governments. This is in stark contrast to Bitcoin, in which its supply growth is baked into its code and transparent to everyone. Cathie argues this is why, over time, investors will inevitably turn to Bitcoin for financial security. Cathie also foresees worsening market and economic conditions as the Federal Reserve leaves interest rates higher for longer, which will lead to a harsh recession. Make sure to stick around to the end of the video as Cathie Wood breaks down why Bitcoin is a life raft as economic conditions worsen. But before that, today's video is brought to you by Crypto.com. If you still haven't got a crypto card yet, you're living in the past. With traditional cards, you have to pay annual fees, they take percentages, and some banks charge you at every transaction. That's not the case with the Crypto.com Visa card. With a Crypto.com Visa card, you can spend your crypto anywhere you want, and the benefits are insane. With your Crypto.com Visa card, you can earn up to 5% back in Crow rewards on every transaction, enjoy 100% cash back on Spotify, Netflix, and Amazon as a new customer for the first 6 months, get complimentary access to airport lounges and elevate your travel experience, and flaunt your style with the sleek and stylish metal card. Now, Crypto.com is currently giving out a $25 new user sign-up bonus for Jamie Tree viewers. Here's how to get your $25 bonus and start earning up to 5% back. First off, download the Crypto.com app by clicking the first link in the description or scanning the QR code on screen now. Second, sign up using our referral code nutty for your instant $25 bonus. Thirdly, once you've signed up and have been approved, here's how to get your Crypto.com card. Tap the card tab at the right of the navigation panel, select your preferred card tier based on the required cardholder Crow staking or lockup amount. I personally have a Ruby Red card. The only requirement is you lock up 400 USD of Crow for 180 days, which is then unlocked. Then accept terms and conditions. And you'll have to have sufficient Crow in your crypto wallet for the 180-day stake or lockup. Finally, submit your delivery address. Then you'll get your Crypto.com Visa card, start making transactions, earning rewards, and enjoying the perks. So to claim your $25 bonus and earn up to 5% back on all your spending, click that first link in the description to get started with Crypto.com today. Now, back to the video.
In the late 70s, early 80s, it took a while to get there, and it seemed to be very sticky. And then after Chairman Volcker came onto the scene, I think that was 1979, he said, we have to get this thing under control. And he started choking money supply. And that momentum actually continued into the mid-90s. And then in the mid-90s, it's very interesting because it's somewhat similar to today. In the mid-90s, there was a domino effect of currency devaluations around the world. Our monetary policy was propagating throughout the world because it is the world's reserve asset. And the first devaluation actually was Mexico, and it was a big one. I remember it very clearly because we were involved with Mexican stocks. And then a few years later, we had the Asian domino effect. I think the Thai baht devalued in 1997, and then the rest of Asia's currencies devalued. We had the Russia default in 1998, and then we had long-term capital falling apart. Monetary policy propagates through the system, and when it's so unpredictable, it leads to all kinds of excesses. And so what do we have now, where we see what happened because of COVID? That drove the 4-year annualized growth in M2 up to 12%, and then now we've had a very sharp deceleration. Unlike the 70s, 60s and 70s, where there was sort of an acceleration, at least the sense of a trend, and a stabilization near double digits. Here we had money thrown at the system to prevent an outright depression. And if by the end of the year we stabilize around 0% year-over-year growth, that's year-over-year, this line will drop toward 2 to 3%, which, as you can see, we've only seen once. It was in the 90s, and after that, all hell broke loose around the world. The Fed has kept interest rates higher for longer, meaning the length of time from its last rate hike to the first cut. And you can see we're above average now. And you can also see the last 3 times this happened, when we were higher than even we are now, was a harbinger of the 08-09 global financial crisis. It was a harbinger of the tech and telecom bust in 97-98. And in 1969-70, it was the harbinger of a recession. We're in a very interesting environment, and it's caused by monetary instability around the world. Yassine about these devaluations. And of course, in emerging markets, anyone with a connection to the internet now pretty much can establish or buy an insurance policy in the form of Bitcoin, which, just flipping back to the halving in this purple line, doesn't look anything like the volatility you see in monetary policy here in the United States and around the world. And of course, it's controlled by human beings. When we went off the gold exchange standard and closed the gold window in the United States in 1971, monetary policy just became unhinged, and it has been unhinged ever since, although human beings have tried to contain the inflationary ramifications, and they take it too far both ways. And right now, we think they're taking it too far on the downside. Here's the real Fed funds rate. So the Fed funds rate is roughly 5.5% and 5 to 5.5%. And you can see the minus 3% gets us 2.5% there. If inflation does come down the way we expect, and the Fed does not cut rates, which the markets now don't expect one until November, if they don't cut as inflation's coming down, then this line is going to go out closer to 5%. Again, we haven't seen that really since the 80s, when inflation was still considered embedded or risk of going back to double digits. We're nothing like that today. On the next page, this slide is how long the Fed has kept interest rates higher for longer, meaning the length of time from its last rate hike to the first cut. And you can see we're above average now. And you can also see the last 3 times this happened, when we were higher than even we are now, was a harbinger of the 08-09 global financial crisis. So that was 06-07. It was harbinger of the tech and telecom bust in 97-98. And in 1969-70, it was the harbinger of a recession. Just a quick note on fiscal policy. You can see the deficit. We present this each time and just want to reinforce that the antidote to this deficit, which in a so-called expansion is at 6.5%, that really has not happened except in the aftermath of the 08-09 meltdown, while stimulus was still flowing freely in response to it. But we're not in such a meltdown now, and we do believe growth is going to be the solution, as it was in the 90s. You can see the 90s in the Clinton administration for the most part. We ended up back in a surplus, which was a function of the very good growth. And I'll mention that internet really started to take off in the early 90s, and that was a big part of that decade of growth. And we think the ChatGPT moment is very similar to what happened in 1993, which was the first time that email was connected to the internet. It was a big moment, just like ChatGPT was for artificial intelligence. And we think AI is going to be a huge catalyst and is going to stimulate and accelerate the growth in our other innovation platforms, which are robotics, energy storage, blockchain technology, and multi-omic sequencing in the life science space. All of those are getting ready to deliver massive growth rates that will really move the needle in terms of GDP. Unlike the aftermath of the tech and telecom bubble, the technologies, the internet was going and the growth was very good, but some of the expectations, like personalized medicine, we were not near that at all. We are now. And so we think this federal deficit, if there's any discipline whatsoever in terms of spending, that it could move into surplus territory, which is something that the market does not expect. Listen very carefully to the candidates, all 3 of them, as they put forth their economic plans, and we'll be talking a lot about those in the future. But tax rate increases, especially capital gains tax rate increases, would undermine the scenario I just presented. So we definitely don't want those. All right, on to economic indicators. If you look at where the economy has been in past cycles, when it's been around these levels, we've been, in many cases, moving towards a recession. And you can also say we were moving towards a soft landing. So it's kind of in never land right now. The last tick was down. It was a small tick down, but pay close attention to this. We think there will be more ticks down because we do think that today's unemployment rate was harbinger of more soft employment numbers to come. And before I get into employment, I do want to reinforce what I'm saying about that sentiment indicator. It's probably on its way back down. This is a good indicator. Here we've got 4 really fast casual or fast food restaurants: Yum, Starbucks, Chipotle, and McDonald's. And you can see they are resolving to the downside. And there's no pickup here. And we'll get into why in a few moments. But I know that to see Starbucks sales, these are same store sales, but total revenue at Starbucks was negative. And we did see negative in COVID, of course. But for Starbucks, that's been highly unusual. And it's basically saying, Starbucks is discretionary. I mean, you don't have to go out and buy that cup of coffee. You can make it at home. And I do think that trading down is happening. So negative numbers, highly unusual there. And they're all soft. Chipotle's held up the best, I think. And I think they're being sensitive in terms of pricing. I think they've taken, they're limiting the chicken dishes because that's still high priced. So I think they're being more sensitive from a pricing point of view.
So there's Cathie Wood giving us a rundown on current global economic struggles and why Bitcoin is the solution to the problem. According to Cathie, the Federal Reserve's decision to keep interest rates unchanged is causing more harm to an already struggling economy. She points out that several currencies, like the Egyptian pound, Nigerian naira, and Argentine peso, have lost a lot of value against the US dollar in the past year, between 40 to 60%. For example, the Egyptian pound has lost more than 2/3 of its value against the dollar since early 2022 due to a shortage of foreign currency. However, Cathie mentions that fortunately, people in these countries have found a solution to protect themselves from currency devaluation by buying Bitcoin. With internet access, everyone can easily buy Bitcoin to safeguard their money. This is how millions in poorer countries protect their savings from their national currencies losing value. Before we go, a quick reminder for those who are keen on staying updated in the fast-paced world of crypto and Bitcoin. Consider subscribing to our daily 5-minute crypto newsletter. It's a concise resource for the latest expert predictions, breaking news, and top on-chain analysis trusted by over 60,000 subscribers for insightful crypto investment information. Click the first link in the description to join our community and elevate your crypto investment knowledge today. Anyway guys, hope you all enjoyed today's video and that provided you with some value. I'll see you all in the next one, and as always, all the best.